Hello, Mike Swanson, WallStreetWindow.com here. Options can be simple, even if they might sound intimidating or complex to you. They're not about trying to go up to bat and hit a home run or swing at the stock market as hard as you can. It's about using math and science to your advantage, and then it becomes very simple. And I put together a presentation to explain things to you really fast. So take a look at this.
In this video, together, we are going to simplify stock options, and we're going to make what is complex simple. The reality is that's how you can use anything in the financial markets properly. But if you've ever bought an option before, the odds are you've lost money and you feel as if they're very complex because there's so many factors that have to come together for you to actually profit after you buy an option. And if you've never bought an option before, you may be intimidated by them. Well, this video is going to fix both of those possible situations you may be in, so we can go forward from there and use these things to our advantage properly. But first, I got to tell you, do not be fooled by anybody who tells you that options are investments. They're not. And don't be fooled by anyone who leads you to think that options are simply substitutes for owning stocks. That instead of putting a big investment into a stock as investment, you can just use an option and put in 1/10 of the money and doing the same thing. These are not investments at all. They're, in fact, the complete opposite of an investment. And it's understanding that first that enables us to recognize the reality of what options really are and then take advantage of it and not be fooled and lured into doing things that rarely work. You see, what an option truly is a pure bet and nothing more. It's a bet that a stock is going to go up over a certain price within a certain amount of time, or drop below a certain price within a certain amount of time. That's a bet. It's nothing more than a bet, and that's why it's not an investment. If you buy a stock, you're owning an interest in a company. It might be a good company, in which case you've got a great investment. If it's a crappy company, then it's likely to be a crappy investment. But you own something. You're an owner. When you buy an option, you own nothing but a bet. That's it. It's a gamble. Options are gambling. The options market is a place that attracts people who are speculating and gambling on whether something's going to go up or down. And to give you an example of how a call option works, a call is a bet that a stock will go up over a specific strike price. That's the price it has to go up and above in order to make money, and it's got to do this within a certain amount of time. So, for example, let's say there's Facebook out there, and say Facebook's trading at $150, and you buy January 2018 calls with a strike price of $200. That would mean that Facebook between now and January 15 has to go above $200 for your call to become profitable, for your bet to become profitable. If Facebook does not do that by January 15, that call, that gamble will become completely worthless. Now, another example, say it's September the 1st, and you buy October the 7 calls at 175. You may think, well, it's got a better chance to do that because the strike price is lower. Say we're at 150, it's only 25 points instead of 50 points. Yeah, but the time factor is shorter in duration. And generally speaking, the shorter the time factor and the further out the price that strike price is, the cheaper the option is to buy, and that attracts people into taking what they think are high leverage gambles, using small amounts of money to buy on things that rarely happen. If the option is closer in strike price to the real trading price, it'll be more expensive. It'll cost more money to put in, and the longer the time frame out too. But the shorter the time frame, the further the price is out, the less likely the option is to hit. And 90% 50% and more of options expire worthless. Let's give you an example of a put. A put is a bet that something will fall in price. In this case, let's say Facebook's at 150. We're going to buy a January 15, 2018 put with a strike price of 100. Facebook must fall below 100 before that expiration date of January 15 for that bet to become profitable. Let's say the bet is the same strike price, but this time October the 7th. It's got to fall below 100 still. And again, which is more likely to happen is, further out in time, but that put is going to cost more for anyone buying it. Now, some people use options to hedge positions because, in effect, what they would be doing is, say you own 100 shares of Facebook. In this case, let's say you bought the Facebook shares at exactly $100, and you are buying these put instruments that will go up in value if that strike price is hit in those time frames. What you'd be doing is hedging your initial investment no matter what the Facebook is trading at. And that is something people do with options that can be prudent. If you think the stock market is going to decline and you don't want to lose money, you can buy puts to hedge already existing positions. That's why some people are out there selling puts, selling calls. They may own the stocks. They may be looking to do that to make money. And that's what I do, but I do that on stocks I don't own. And the details to get into my course on doing this and to get my specific trades, click the link below this video. Go to optionsincomegenerator.com, optionsincomegenerator.com. You'll get my trades in which I sell options to people who are essentially gambling maniacs. And they face a giant problem. If you buy call options, these are essentially lottery tickets, especially if they're close in time, far in strike price, that rarely ever pay out. And the people who enter the options arena doing this are essentially coming up to bat, swinging and missing, swinging and missing, swinging and missing, over and over and over and over again. And this is really how the bulk of the trading public tries to play the options market, and that's why they feel like it's so complex, because they're trying to hit a baseball. Essentially, I mean, professional baseball players can do it, and it's tough, man. I can't go up to bat in a baseball stadium of professionals and expect to hit a ball flying at me 95 miles an hour. Likewise, it's very difficult to buy an option on something far out of the money that's going to expire in a certain amount of time and hit it. It's a long shot lottery ticket, and that's why the options are the closest thing in the financial markets to an actual casino. That's the brutal reality. This is not a place of fast money for people who are buying calls and buying puts. It just is not fast money. It's not easy money. It is pure gambling, pure raw speculation. And what my whole way of actually using this situation, that is what the options market is, to generate options income, is to become the house. It's to own the ballpark. It's to own the baseball team. Yeah, I can't come up to bat and hit a baseball flying 95 miles an hour, but if I owned a baseball team, that wouldn't matter. Well, we're not going to go out and buy a baseball team. We don't need to have the hundreds of millions of dollars or billions of dollars to buy a business of, let's say, buying the New York Yankees. We're not looking to do that. We're looking to simply use the options market and accept the casino reality of that to create options income. It's right there in front of us. This options income opportunity is there for us for the taking. So click to optionsincomegenerator.com. Go there and get all the details, get my reports, and I'll see you on the other side.